Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So, you might have heard of the news already. We got Bank of Canada cutting interest rates by 25 basis points. Right? We also had the European Central Bank also cut interest rates. And we also had some data that came out from the US and from Canada as well. But I'm going to first focus on Canada here. Talk about a couple of things that probably your friends or your realtors probably don't really mention. Now, this is not a fear-mongering video. I'm not here to scare anyone. Here to educate. Here to prepare for the worst outcome, because you should be, right? Not telling you, this is not investment advice. I'm not telling you to sell everything and go crazy. Of course, you need investments to keep up with inflation, but it's always good to be prepared, because if you're prepared, you'll never be worried or scared of what is to come, right? So let's talk about Bank of Canada first. We had Bank of Canada come out, cut interest rates. They did discuss about that there's a possibility they could do more. They could do more rate cuts, definitely. So you could see Bank of Canada even do 2 more rate cuts this year. Now you may think, okay, that's a win, that's amazing, thing. We're getting interest rates down, so that means that property prices, real estate, assets will start to go up. Yes, it is positive in theory. Cutting interest rates are positive for the markets, for real estate, especially when it comes to those mortgage rates that a lot of people may have coming due when it comes to refinancing by the end of the year and for next year. Now the thing is, you're not going to get interest rates that are going to be cut aggressively to pre-COVID levels, or to COVID levels actually. And we heard Macklem, head of Bank of Canada, actually say that you're not going to get those rate cuts back to those COVID levels. You're going to get slow and steady rate cuts. And generally, you see that happen. You see that happen in history, where rate cuts come down slowly, and then if there's some sort of black swan event, some sort of major event that causes that recession, you get that massive emergency rate cut. The emergency rate cut is what you want to be worried about. Now the problem is, right, if you look at history, look at all the other recessions back then, you see a slow and steady rate cut, right? And you have, one increment of 25 basis points rate cut, then the next one, then the next one, and then lo and behold, 6 months to maybe a year later, then you get those aggressive rate cuts. So if everything's fine, nothing happens, then yes, you get those slow and steady rate cuts. If something bad's happening, aggressive rate cuts doesn't necessarily mean that's a good thing, because that tells you there's something in the economy that is really troublesome for the for Canada, right? Or for Bank of Canada to go and do that aggressive emergency rate cut. Now, we saw Canada, the first G7 country to cut rates. We had European Central Bank do that. The only question is that when is the Fed, when is US going to cut rates? Now the US had its employment numbers come out stronger than expected, better than expected, which basically, if you look at the swaps that price in interest rates, you have the swaps basically price in no rate cuts for the year, right? And there's all this debate out there. Are we going to get rate cuts or not? We will hear from the Fed when it comes to rate cuts. Now, the thing what you want to understand and know is that once this rate cut cycle starts, let me turn around. There's a lot of wind. Once this rate cut cycle starts, right? Especially globally, especially from G7 countries, it's inevitable that the Fed will cut rates as well, right? We will see that happen. And when could that happen? Well, we could see it more closer to the end of the year because the US economy has been quite resilient and strong. So then why is Canada cutting interest rates, right? Why is Canada going out there and cutting interest rate all of a sudden if things are okay? And why is it that Bank of Canada is saying that they might do 3 rate cuts this year, especially if inflation's coming down? Now, what was Bank of Canada's argument? Bank of Canada's argument was that, hey, we're gonna cut. Reason we're cutting interest rate. We're going into easing mode because I'm gonna get into shade here. It's a little hot outside. We're getting into easing mode because inflation is coming down to the levels that we want, right? And it's getting to, and we're seeing the progress in inflation. As long as we're seeing progress on inflation, we are going to continue to cut rates. Now, here's what no one is telling you, okay? Look at the jobs number on Friday. Okay, yes, the jobs number on Friday for US and Canada came in stronger than expected. Better, good. But look at the unemployment numbers. It ticked up. Let's talk about Canada. Canada's unemployment numbers came around 6 point something percent, so plus 6%. Okay, the lowest number was back, I believe, a year or so, around 4.9%. So you had basically from that point till now a plus 1% increase in the unemployment rate. And we're starting to see the unemployment rate really tick up. Now, what do we know in terms of history? That when we see a 0.5 plus percent increase in the unemployment rate, it follows with a recession later on, right? Tends to say, okay, the economy's getting weak. Thus, you get these preemptive rate cuts that come in, even though the shelter component in Canada's CPI report is still moving up, even though you have housing prices moving up, rent is still elevated at high levels. Why are we cutting rates? You may argue that, okay, rate hikes, were contributing to the higher shelter component of inflation. Sure, yes, of course it is, right? Higher mortgage rates, you're going to pass it on to the renters, right? So in theory, you could say if you're cutting rates, that will also bring the level of inflation and shelter component to come down. However, if you look at the unemployment rate, you can see the damage has been done. And when you get that increase, definitely with the low demand that you're seeing in the economy, the unemployment rate moving up, certain big companies in Canada laying off workers, this is just the beginning. Let's not also forget about the productivity issue in Canada. There's very weak productivity issue happening there, even though there's a lot of immigrants coming in, right? That's also creating weakness in the productivity in Canada and the growth in Canada, which can definitely be a bad sign down the road, especially if you get that recession. So what I'm trying to explain here is that in history, when you have this increase of 0.5% in the unemployment rate, you have always seen a recession follow through, and you've seen that unemployment rate really spike up, thus causing the job losses to happen quite aggressively. Now, will it happen right away? No, it's going to take its time. Like we're seeing right now, everyone's very optimistic. The stock market's up. Nvidia is all-time highs. We're heading into Nvidia is going to split soon. We have GME and all these like meme stocks really pumping and pumping. And you have the narrative coming out that where's this recession? This is a soft landing. It's okay. We're fighting inflation. The economy is strong and resilient. When we look at the U.S. side of things, yes, the economy's strong, resilient, although there are some pointers I could argue that there's weakness there. But according to the last jobs report, the non-farm payrolls report, yes, you have strength there. But there was weakness in the ADP, in the previous ISM numbers as well. And you did hear a lot of layoffs. Where is that? Why is that not being talked about? And why is that unemployment rate, even from the US side of things, which have also ticked up more than plus 0.5% as well? If you look at the unemployment rate on the US side, it is looking much better than Canada's, but you do have that plus 0.5%, which again goes to that rule that when you see that happen, you tend to see that recession later come through. Now, again, you're going to be blindsided. People are going to tell you it's totally fine, good time to buy. You're going to have realtors who have no understanding of economics and data and history, right? And go out and tell you that, okay, yeah, the rate cuts are a good thing. Let me repeat, yes, they are, depending on where you are in the cycle and depending on the economic data and what happens. When you have the yield curve in negative territory where it is right now for quite some time, and you have stress and you have the unemployment rate tick up, like it is, like I've explained, in history, when you put it all together, 9 out of 10 times, it has led to recessions. Just look at history, simple as that, okay? So I'm gonna leave it off on that. Yes, great, you have the interest rate cut in Canada. Eventually, US is also gonna do the same thing, which is great. It may hold asset prices up for some time, but what you need to worry about is if those rate cuts start to come in faster and faster, and you start to see that unemployment rate go up higher and higher, those job cuts, you know, next, eventually there's going to be some sort of emergency cut. And that's when you know the shit's going to hit the fan when that time comes, right? So I would say give it about, I could be wrong on the timing, but year and a half for that to maybe show up, the weakness in the data. And I think you'll start to see what I am talking about. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video, and I'll see you guys around. Cheers, and bye.